Brendan Bernstein is a founding member of Tetras Capital Partners, LLC, an investment manager focused on investing in cryptocurrencies and blockchain assets. Cryptocurrency investors are blind to the most important factor of any investment: valuation. Merely uttering the word blockchain has been a hypnotic weapon, sending investors into a trance where they clamor to buy at any price. Teacup from Get Out, the process of sending blockchain investors into hypnosis. Roblox investors in the sunken place. This isn't the first time growth investors have gone wild. Technological innovation typically turns investors into emotional basket cases. Today, a blockchain protocol with any facade of technical aptitude is valued at 8 figures. Throw out a $10 term like DAG or interoperability, and you'll get 9 figures. And these low 8 or 9-figure valuations are turning into 10-figure valuations. Wash, rinse, repeat. The blockchain voodoo is working. Blockchain investors using Jobu to increase protocol valuation. Well, for people who view tokens as a casino chip instead of an asset whose value will ultimately converge to fundamental value. Spoiler alert, this won't end well. Crypto assets are different. Hiding behind the pseudoscience of white papers and platitudes like decentralized technology bringing a new era, many investors believe crypto assets are different. If transactions increase, the protocol will go up in value. History tells us it can't be that simple. The Nifty 50 of the 1960s, a group of 50 stocks that represented some of the fastest-growing companies on the planet, bought regardless of price, epitomizes a case of growth investing gone wild. The goal of the approach was to identify companies with the most optimistic outlooks in earnings growth. The stocks that highlighted America's great stocks lists were Xerox, Kodak, Motorola and Texas Instruments. These stocks were meant to be bought and held, not sold. As a result, investors disregarded valuation. The prevailing mentality was that, even if the asset is expensive today, it will grow into its price. Hold, they said. The resulting P/E ratios in 1972 are shown below. What do you notice about the names above? The spectacular growth abruptly came to an end for many from technological obsolescence and competition. P/E ratios for the 50 stocks selected collapsed to 10. By 1975, the Nifty 50 had shed 2/3 of its value. Remind you of anything? Newly conceived ICOs are raising at valuations in the hundreds of millions, and the same venture investors that would scoff at a $500 million valuation in the real world are lining up to buy tokens with no recourse and without any regards for valuation. The valuation is the least important factor instead of the most. And as a result, there are 24 early-stage crypto assets with a valuation over $1 billion, most of which only have one value proposition: speculation. If you were planning to buy a new house, hopefully you'd ask what the price is. But instead, just like with housing leading up to 2008, blockchain investors have been lured into believing that growth alone obviates any need for valuation rigor. When price starts to diverge from value, and growth at any price becomes the general market sentiment, risk-adjusted returns fall dramatically. Crypto investors will ultimately need to have a strategy, other than selling the token to a greater fool. The long-term crypto investor, the most important factor driving an investment success or failure is the relationship between the price you pay and the asset's worth. A fundamentally strong asset can be a bad investment if too optimistic of expectations are priced in, and vice versa. What tends to get investors into trouble is conflating interesting asset with interesting at any price. I'm fascinated by the vision for a world computer. But that alone doesn't mean Ethereum is a high expected value bet at a $100 billion valuation. Objective merit alone is about as good of a predictor of price increases as Jamie Dimon's forecasts are. There are two fundamental investing approaches that warrant dissection: value and growth. Value investors look to buy the proverbial $1 bill for 80 cents. Growth investors look to buy a $1 bill that can turn into a fancy new biotech drug or consumer application worth $5 10 years down the road. Either strategy can work, but regardless, both schools of investors still need to accurately price and understand what constitutes low and high for any given asset. If the asset purportedly worth $1 turns out to be worth 25 cents, both investors are overpaying and reducing risk-adjusted returns substantially. Generally, the early-stage investment realm is dominated by growth investors due to the difficulty of determining present fundamentals. Due to the future uncertainty, growth investors like venture capitalists typically require a higher rate of return to compensate them for the risk. According to CB Insights, only 0.91% of startups make it from seed stage to greater than $1 billion in value. Thus, seed valuations need to be more than $10 million, $1 billion multiplied by 1%, and returns need to be higher than 100x for the bet to be expected value positive. At that failure rate, 100x multiplied by $01 equals 1x money. This is a slight oversimplification but helpful for purposes of this analysis. The bottom line is that the initial value